With interest rates at record lows, should you fix the interest rate on your mortgage? Today, we're going to talk about fixed rate versus variable rate loans, the pros, the cons to help you make the right decision. Now, as always, all the information in my video should be considered general information only. It's not to be considered financial advice. All right, so the first loan type we're going to talk about today is the standard variable rate or SVR. Now, this is the most common loan type that you're going to find. Now, as the name suggests, variable rate loan, this means the rate can fluctuate depending on what is happening in the market. Now, with this uncertainty, there is a lot of flexibility that comes along with this. Now, some of the benefits of having a variable rate loan are the features that come along with that. Now, the first feature that we're going to talk about is the ability to make extra repayments. Now, you can do this on a variable rate loan. You can pay as much extra as you want. Now, this is great if you're looking to pay down your loan a lot quicker, or maybe you've come into a lot of cash, you've got a bonus, whatever it is, you can pay down the loan without penalty and without cost, and that is going to reduce the interest that you're going to pay over time. So this is a great feature of variable rate loans, being able to pay as much as you want, whenever you want. Now, another benefit of variable rate loans is the ability to have a 100% offset account. Now, what an offset account is, it's literally just an everyday account that's linked to your mortgage, but whatever money is sitting in that offset account, that is going to offset the interest payable on the mortgage. So for example, if you had a $500,000 mortgage and $10,000 sitting in your offset account, you're going to pay interest on $490,000. Now, this is a great way to save on interest payable without really having to pay extra on the loan. So again, just that added bit of flexibility of you being able to hold on to your cash and use it at any time, but also save money by having the mortgage interest rate offset with the money that is sitting in that account. And the other benefit of variable rate loans is the ability to have a redraw facility on the loan. Now, a redraw facility is only available if you've made extra repayments and you're actually ahead of the payment schedule. So if you're ahead, you can then basically withdraw the cash as you would in an everyday account and go and spend it as you wish. But you've got to be ahead on the loan. But again, that added flexibility of being able to make extra repayments, and if you need it, you can actually withdraw it and go and use the cash for whatever you need. So with the uncertainty of the loan rate fluctuating, you do get some great benefits that can really help you pay down your mortgage a lot quicker and save on interest as well. So some of the pros of variable rate loans are obviously just the features that we've spoken about: the redraw facility, the offset account, and being able to make extra repayments. But another pro of variable rate loans is the ability for you to refinance at little to no cost. So if you find a better deal at another bank, you'd be able to refinance that mortgage very easily and go and get yourself a better deal. So again, that added flexibility of being able to move your mortgage whenever you like and whenever you get a better deal. And of course, the other pro of variable rate loans is the ability for you to be open to interest rate cuts. Now, when the Reserve Bank lowers the interest rate and that is then passed on to consumers, you would then obviously benefit from that, having a variable rate loan. If the rates drop at your bank, you can bet that your rate will drop as well with that. Now, some of the cons of variable rate loans is quite obviously the interest rate rises. As we just spoke about, the rates can drop. The rates can also rise. Now, if that happens and that gets passed on to you, that is obviously going to be costing you more money because you're going to be charged more interest at the end of the month. Now, the biggest downside of variable rates is the uncertainty that comes with that. I mean, you get a lot of flexibility, but at the same time, you don't really know next year, 5 years from now, what the interest rate is going to be. So that little bit of uncertainty can steer some people away from going variable rate on their mortgage. Which brings us to fixed interest rate loans. Now, a fixed interest rate loan is an agreed interest rate for a set period of time. Now, generally, most people are going to fix it anywhere between 1 to 5 years. In some cases, you can do more, but 1 to 5 years is generally the normal term for fixing an interest rate. And the benefit of this, despite rate cuts or despite rate rises, your interest rate is going to stay the same for that agreed period. So a great way to get some certainty around the repayment schedule that you have coming up, which makes it a lot easier to budget and plan for. And at the end of the fixed interest rate period, the rate will then revert back to the standard variable rate, or you can then fix it again for another set period of time. So some of the pros of going fixed on your mortgage is the certainty around the repayments. For those of us that like to know exactly what we have to pay for a fixed period of time, and we can budget and we can plan accordingly, this is a great way to be able to do that. But some of the cons are if interest rates do drop at a reserve bank level and that's passed on to your bank, your rate, if you have it fixed, does not change. So you could end up having a rate fixed at a lot higher than what the standard variable rate is. The other downside is that it is very difficult, not impossible, but very difficult and costly to refinance your mortgage. So if you find another deal or a better deal at another bank to refinance, you're most likely going to have to pay a break cost, which can end up being like several thousands of dollars if you wanted to go and refinance that mortgage elsewhere. So again, a big downside if you're looking to refinance or you get yourself a better deal. And the other downside of going fixed on the interest rate is you don't get the same features as we'd spoken about with the variable rate loans. Now this means that you can't make extra repayments on the loan. And in some cases you can, up to a certain limit. That's generally around $10,000 a year extra. But if you're looking to pay down your mortgage really quick, you don't get those benefits. In some cases, you don't get access to an offset facility and you can't redraw any money that you've put onto the loan. So at this point, if you're still not sure on what to do, here's some things that you can ask yourself to make the right decision. Now, if you're planning to sell the property in that fixed rate period, it's probably best to not go fixed, because as I said, if you pay out the mortgage during that fixed rate period, you're gonna pay an early exit fee, which can tend to be several thousands of dollars more than you really need to pay. So if you're planning on selling the property anytime soon, probably best to avoid going fixed on the mortgage. The other question to ask yourself is, do you plan on using the equity in the property to go and buy another property, for example? And if you are, then it's probably best again to avoid going fixed, because by doing that, it's going to be very difficult to restructure and refinance your loan, as opposed to if you had a variable rate and the flexibility that goes along with that type of loan. The other thing to ask yourself is, are you looking to make extra repayments? Like, do you want to pay down your mortgage as quickly as you possibly can? And if you do, it's probably best that you go variable, because then you're not going to get penalized for paying extra on your mortgage. And again, if you need the money at any point, you can always redraw that out without cost, without penalty. So again, the flexibility with a variable rate may be beneficial in that scenario. And another thing to consider is, do you want the features that come with a variable rate loan? Like, do you want to make extra repayments? Do you want the redraw facility? Do you want the offset account? Those things can tend to save you a lot of money in the long run. So if those features are appealing for you, then it may be best to consider going variable as opposed to fixing the interest rate. And a big question to ask yourself is, if you fixed the interest rate, how low would the standard variable rate need to go for you to actually have lost that bet? This is something, if you're unsure at this point, probably best to speak to a mortgage broker to weigh up your personal circumstances and go through in detail what might work best for you in each scenario. But that's it for today's video. If that helped you in any way, smash the like button. It's the best thing you can do for the channel. If you want to see more content just like this, I release a video once a week on personal finance and investing. Consider subscribing. Until next time, thanks for watching. I'll catch you soon.